Um, Good afternoon, members of Monetary Policy Committee, other directors, and members of the press. You are welcome to Central Bank of Nigeria. The Monetary Policy Committee met on the 22nd and 23rd of November 2021 in light of continued recovery of the global economy and improving output growth in the domestic economy. Though the growth outlook for the global economy for the rest of the year and into 2022 remains favorable, the uneven pace of recovery across countries has persisted. This was driven primarily by COVID-19 vaccination rate, size of policy support, and regional economic conditions. On the domestic front, the continued support by the monetary and fiscal authorities is sustaining the growth recovery in Nigeria, notwithstanding the persistence of security challenges and legacy infrastructural constraints. The committee appraised the developments in the global economy, international financial environments, and the domestic economy, as well as the outlook for the rest of the year and the first quarter of 2022. 10 members of the committee attended this meeting. The global economic development. Global output growth has remained upbeat as economic agents defy the continued threat posed by the sharp rise in infection rates associated with the Delta strain of COVID-19 virus. The IMF, on its part, in its October 2021 World Economic Outlook, downgraded, albeit marginally, its growth forecast for advanced economies in 2021. The downgrade was, however, offset by an upgrade of the growth forecast for the emerging markets and developing economies in 2021. Despite the forecast for a robust recovery of the global economy in 2021, the uneven pace of vaccination across the globe and the continued rise in infection rates by the more fatal and mutating strains of the COVID-19 virus suggest that the current two-speed recovery of the global economy may persist longer than anticipated. This may, however, be remedied if governments across the globe rally to improve coordination in the distribution of vaccines to aid the early attainment of global herd immunity. The committee noted that the downside risks to the recovery may persist if the spread of this new variant is not addressed urgently. In light of the above dynamics and associated headwinds, the IMF downgraded its 2021 growth forecast for the global economy from 6% to 5.9%. It also revised the projection for the advanced economies downwards from 5.6% to 5.2%, while the forecast for the emerging markets and developing economies was revised upwards to 6.4% from 6.3%. Inflation across several advanced economies is expected to continue its upward trend in 2022, contrary to earlier expectations of transiency, as commodity prices continue to recover and feeding into energy and goods prices. This is on the backdrop of rising demand associated with a sustained rebound in global output growth amid lingering supply constraints. In response to the persistence of price developments, the US Fed commenced tapering its monthly bond buying program. Other advanced economy central banks have also indicated the likelihood to follow suit in the short to medium term. In key emerging market and developing economies, inflation remained relatively high compared with advanced economies. This is mostly due to supply-side constraints associated with the pandemic, exchange rate pressures, and other legacy structural problems. The severity of inflationary pressures in this group of economies, however, varies across countries in relation to the specific structure and dynamics of the individual economies. In the global financial markets, equity prices largely remained a strong post-lockdown recovery, while investors continued to maintain a sizable hedge in gold, possibly to ease the impact of a rebound of the pandemic as infection rates continue to rise. The financial markets remain undoubtedly bullish, suggesting that investors are cautious of the rebound in infection rates and rising inflation in major economies. Price of gold and other precious metals have remained significantly above their post-pandemic levels, an indication that investors have not fully returned to the financial markets. Domestic developments. According to the National Bureau of Statistics, NBS, real gross domestic product (GDP) grew by 4.03% year-on-year in the third quarter of 2021, compared with 5.01 and minus 3.62% in second quarter of 2021 and Q3 of 2020 respectively. The growth trajectory post-lockdown has thus been positive in the last 4 quarters following the exit from the recession in 2020. Quarter-on-quarter, real GDP grew by 11.07% during the third quarter of 2021, compared with minus 0.79% in the preceding quarter. This improvement in real GDP was driven by growth in both the oil and non-oil sectors by 12.05 and 10.99% respectively. The committee also noted the continued improvement in the Manufacturing Purchasing Managers Index, which, though remained below the 50 index points benchmark, rose to 47.3 index points in October 2021 from 46.6 index points in September 2021. This improvement indicated a gradual recovery of output growth, driven largely by the increase in new orders associated with rising aggregate demand and upswing in business activities. The non-manufacturing PMIs, however, declined to 47.5 index points in October 2021 from 47.8 index points in September 2021 as uncertainties persisted around the poor security situation. Committee noted the continued moderation in headline inflation year-on-year to 15.99% in October 2021 from 16.63% in the previous month, the 6th consecutive month of decline. The decrease was attributed to a marginal decline in both the food and core components to 18.34 and 13.34% in October 2021 from 19.57 and 13.74% respectively in September 2021. Inflation, however, remained above the bank's implicit tolerance corridor of 6 to 9% and above its benchmark policy rate of 11.5% despite its progressive decline. Observing developments in the monetary aggregate, the committee noted that broad money supply M3 grew by 7.1% in October 2021 compared with 4.72% in September 2021. This was driven by growth in the non-net domestic assets NDA by 9.12% in October 2021 compared with 10.71% recorded in September 2021. Net foreign assets NFA, on the other hand, contracted moderately by minus 1.5% in October 2021 compared with minus 20.85% in the preceding month. The continued growth in non-net domestic assets was largely driven by increased claims on the federal government and other public non-financial corporations, private sector, and state and local governments. In the financial markets, money market rates oscillated within the standing deposit facilities corridor, reflecting the prevailing liquidity conditions in the banking system. The monthly weighted average open buyback (OBB) rate increased to 12.18% in October 2021 from 11.11% in September 2021, while the monthly weighted interbank core rate decreased from 13.21% in September 2021 to 10.10% in October 2021. The increase in the open buyback rate reflected the tight liquidity condition in the banking system. MPC noted the positive performance of the equities market in the review period, with the all-share index and market capitalization increasing to 43,199.27 and 22.55 trillion on November 19, 2021, from 39,219.61 and 20.43 trillion on August 31, 2021. This depicts improved investor sentiment following impressive corporate earnings of listed corporations on the exchange. This led to a new bargain hunting drive by investors. The MPC noted that the capital adequacy ratio and liquidity ratios both remained above their prudential limits of 15.2 and 41.2% respectively. The non-performing loans ratio at 5.29% in October 2021 reflects progressive improvement compared with 5.7% in October 2021. The committee, however, urged the bank to sustain its tight prudential regime to bring the non-performing loans ratio below 5% prudential benchmark. The gross external reserves stood at $41.4 billion as at November 18, 2021, compared with $41.34 billion in October 2021, a moderate increase of 0.17%. Our outlook. The overall outlook for both the global and domestic economies remain upbeat, but the significant domestic downside risks clouding the path to full recovery. The key risks remain the unabating COVID-19 pandemic and uneven progress in vaccination. As the US Fed commences scaling down of its monthly bond buying program, there is increased likelihood that other advanced economy central banks will follow in the same direction. With this impending development, external financial conditions will likely tighten for most of the emerging markets and developing economies in view of huge capital flow reversals to the advanced economies as yields rise. This will no doubt deepen the growth divergence between these two groups of economies. Forecasts for key macroeconomic variables for Nigerian economy indicate continuing rebound in growth recovery for the rest of the year. This is expected on the back of continued support by both the monetary and fiscal policy, sustained high crude oil prices, and most importantly, availability of COVID-19 vaccines, as well as high turnover for vaccination in Nigeria. Accordingly, the Nigerian economy is forecast to grow in 2021 by 3.1% CBN estimate, 3% by federal government estimate, and 2.6% by the IMF estimate. Inflation is expected to continue its downward trajectory as the harvest season sets in and the government works on improving the security situation to ease the bottlenecks constraining food supply. The committee's consideration. The committee commended the continued recovery in output growth following a positive outcome in the third quarter of 2021. Based on the current outlook for price development and growth, members carefully reviewed the options confronting the committee in the short to medium term, taking into consideration key downside risks to growth and upside risks to inflation. Members reiterated the need to remain cautious and urged both the monetary and fiscal authorities to sustain their support for the recovery as the pandemic was yet to be over. Committee, however, noted that with the sustained intervention by the CBN, economic activities will normalize in the short to medium term, leading to improved output growth and lowering of inflationary pressure. The MPC also urged the fiscal authorities to sustain the current efforts to revamp the economy through continued support to the critical sectors of our economy. The continued security challenges across the country remained a major source of concern for members, noting its impact on business confidence, foreign investor inflows, and overall economic activities. The persistence of insecurity in major food producing areas remained a key downside risk to our recovery. Committee called on security agencies in the country to increase their presence in order to boost public confidence and facilitate the movement of people, goods, and services across the country. With improved security, especially in these food-producing areas, members expressed optimism that food inflation will drop significantly following successful harvest and distribution. Committee also commended the gradual diversification of the economy with increased contribution of the non-oil sector to government revenues and called for more support to increase non-oil exports as a source of foreign exchange into the economy. Members reiterated the impact of poor infrastructure on rising domestic price levels, urging the federal government to prioritize investment in public utilities to improve the business environment. These include transportation network, power supply, education, and health. Following the President's recent international call to investors to channel investments to Nigeria, members were of the view that funding of such projects could be sourced through equitable partnerships with foreign investors and Nigerians in diaspora. Committee noted that the equities market remained in a strong position, signposting continued investor confidence in the Nigerian economy. Members thus urged the monetary and fiscal authorities to build on this sustained confidence to attract more foreign direct investments into Nigeria. MPC welcomed the continued resilience of the banking system in the face of severe shocks to both the domestic and global economies, commending the bank's management for maintaining overall stability in the banking system. Committee thus called on the bank to continue to push for increased intermediation as the way forward to reduce unemployment, create wealth, enhance production, and improve aggregate demand to strengthen its recovery. On this note, members applauded the success achieved by the bank's various intervention schemes, which have contributed to both the demand and supply sides of the economy. Committee reviewed the performance of the bank's various interventions aimed at sustaining recovery of output growth and addressing the downside risk to other external and domestic shocks to the economy. Interventions continued largely in the manufacturing as well as industries, agriculture, energy and infrastructure, healthcare, and micro, small, and medium enterprises. Under the targeted credit facility, the bank has disbursed a total of 363.49 billion naira to 766,719 beneficiaries, comprising 638,070 households, 128,649 small businesses. Under its Agribusiness Small and Medium Enterprise Investment Scheme, AXMIS, the bank has released 134.63 billion to 37,571 entrepreneurs. Between September and October 2021, under the Anchor Borrowers Program, the bank disbursed 43.19 billion to support the cultivation of over 250,000 hectares of maize, sorghum, soya beans, and rice during the 2021 dry season, and 5.88 billion to finance 6 large-scale agricultural projects under the Commercial Agricultural Credit Scheme (CACS). Cumulatively, the bank has disbursed a total of 864 billion to 4.1 million farmers, cultivating 5.01 million hectares of land. The bank also disbursed a sum of 41.2 billion for the commencement of the Brown Revolution, a large-scale wheat program to wean Nigeria off imports by 35% during the first year alone. In addition, the bank disbursed a sum of 261.92 billion for 42 additional projects under the 1 trillion naira manufacturing intervention. Cumulatively, the bank has disbursed a sum of 1.08 trillion under this scheme. As part of its effort to support the resilience of the health sector, the bank disbursed 5.39 billion to 9 healthcare projects under the healthcare sector's intervention facility just within September and October 2021. The bank has also cumulatively disbursed the sum of 108.65 billion to hospitals and pharmaceutical industry. 54 of the 117 projects funded are for hospital service. Committee was gratified that the funding under the health sector has resulted in the establishment of 2 new cancer centers in Nigeria, over 59 MRI and more than 42 CT scan centers all over the country within a space of 18 months. To further promote entrepreneurship development among Nigerian youths, the bank recently approved the implementation of the Tertiary Institutions Entrepreneurship Scheme. The scheme is designed to create a paradigm shift among undergraduates and graduates of tertiary institutions in Nigeria from white-collar jobs towards entrepreneurship development. The guidelines for the implementation of the scheme was recently published as Bank of Industry is presently partnering the bank for the pilot implementation phase. Under the National Mass Metering Program, 8.69 billion naira was disbursed to 4 distribution companies under the scheme's phase 0. The sum of 47.66 billion has been disbursed so far for the acquisition of 858,026 electricity meters. Also, in furtherance of its intervention in the energy sector, the bank released 27.03 billion to power sector players under the Nigerian Bulk Electricity Trading Payment Assurance Facility Program. This is in addition to the 37.69 billion disbursed to 8 distribution companies recently under the Nigerian Electricity Market Stabilization Facility. The bank has also disbursed the sum of 39.2 billion naira under the Nigerian Gas Expansion Program to promote the migration to produce compressed natural gas as the preferred fuel for transportation and liquefied petroleum gas as the preferred cooking fuels in Nigeria. Furthermore, the bank recently introduced the 100 for 100 policy on production and productivity (PPP), designed to create a flow of finance and investments to enterprises with potential to kick-start a sustainable economic growth trajectory, accelerate structural transformation, promote diversification, and improve productivity in the country. It is geared to support private sector companies with the aim of reducing certain imports, increasing non-oil exports, and improving the FX generating capacity of the economy. The bank will select and finance 100 of such companies at 100-day intervals in line with detailed selection criteria as contained in its guidelines, and roll this over for another 100 companies for the next 100 days. The Targeted Credit Facility TCF was particularly highlighted by the committee for its contribution to alleviating poverty at the grassroots in Nigeria. Committee thus urged the bank to continue its support through the Targeted Credit Facility to ensure that more people benefit from this program. With the commencement of monetary policy normalization by the US Fed and impending interest rates lift-off by central banks in some advanced economies, the MPC called on the federal government to intensify its drive towards a counter-cyclical fiscal policy in view of the imminent tightening and external financial conditions. Committee members therefore noted with concern that the gradual normalization of monetary policy by this group of economies will dampen the recovery of several emerging markets and developing economies in the short to medium term due to the sharp reversal of capital flows. Committee also evaluated the development in China relating to the reoccurring pandemic, power outages, and crisis in the property market, noting the likely impact of this could have on Nigeria as a major trading partner. Members thus called on the bank to ensure that necessary buffers are put in place to shield the economy from downsides associated with this development. In general, members expressed confidence in the ongoing policies of both the monetary and fiscal authorities, which in their view was the hallmark of the current recovery and restoration of macroeconomic stability in Nigeria. They therefore called on both the authorities to look beyond the current position and plan towards attracting sustainable investment flows into Nigeria. The committee's decision. At this meeting, MPC was gratified that its policy actions in the past had started to yield positive results, given the remarkable improvement in gross domestic product, which stood at 4.03% during the third quarter of 2021, and the sixth consecutive month moderation in inflation to 15.99% in October 2021. Given the level of its conviction about the efficacy of its actions on macroeconomic variables, MPC felt that whereas tightening would further help to rein in inflation aggressively, it nevertheless feels that tightening will increase the cost of funds and constrain output growth. On the other hand, whereas loosening will lower policy rates, ease liquidity pressures, and stimulate additional credit creation, which will boost output growth, MPC also thinks that loosening will further widen the negative real interest rate gap and compound the price distortions in the money market, which could fuel inflationary pressures. As whether to hold its existing stance, MPC believes that the existing monetary policy stance has supported the growth recovery and should be allowed to continue for a little longer for consolidation to achieve the MPC's mandate of price stability that is conducive to growth. The committee also feels that a hold stance will enable it carefully appraise implications of unfolding global development around policy tapering and normalization by the advanced economies. Based on the foregoing, committee decided on a whole to hold all policy parameters constant to support the enabling environment for sustained recovery of the Nigerian economy. Committee therefore decided by unanimous vote to retain the monetary policy rate at 11.5%. In summary, MPC voted to 1. Retain the MPR by 11.5%, retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5% and retain liquidity ratio at 30%. I thank you most sincerely for your attention.
Yeah, thank you, Governor. That was the communique number 139 of the meeting of the Monetary Policy Committee of the Central Bank of Nigeria. We'll now take questions from the press. We'll start with you, your name, the media house you represent, and then your question.
Good afternoon, Mr. Governor. My name is Ndoka Chejin of the Nation newspaper. The CBN has granted forbearance to banks and their customers over time. This is about to come to an end in March 2022. Now, if the CBN decides to now do away with the forbearance, how are you so sure that this decision will not lead to an increase in non-performing loans? Thank you.
The first question from Nduka talked about the forbearance and that it is tapering to an end is going to expire by March 2022, and how are we sure that withdrawing those forbearance or with the expiration of those forbearance regime, that NPLs will not rise. My answer would be that if you recall, from our standpoint, we've granted a forbearance regime from just two areas. One primarily had to do with the fact that we said that all loans that people, companies, and businesses that are impacted adversely by COVID-19, that they should be given about 2 years. We first of all started by saying 1 year from 2020 to March 2021, and by February 2021, we extended it by 1 more year when the third strain of the virus pandemic continued. We extended by 1 more year, making it 2 years that will expire by March 2022. So 2 years moratorium was one aspect. Another aspect had to do with the fact that we said for CBN interventions that there is a need for us to reduce the interest rate from 9% to 5%. Indeed, another aspect of the intervention or forbearance is that because we knew that the adverse consequence of COVID-19 was resulting in a reduction in the revenue generating capacity of businesses and companies, we also granted the banks an opportunity to allow their customers to ask for a restructure of their facilities. Maybe if it's a 2-year facility, extend it to 4 years, a 4-year facility, extend it to 6 years, a 6-year facility, extend it to 8 years, so as to reduce the impact or the burden of the cash flow on them. At this time, we believe, and those were the periods when there was an unprecedented lockdown of the global economy. All countries, with no exception, were on lockdown. Travels came to zero. People were not allowed to leave their homes. And in Nigeria, this persisted for at least about 3 to 4 months. Now, since from around September, October 2020, Nigeria began a process of easing the lockdown. And notwithstanding the fact that we still saw that around February, March of 2021, that the Delta strain now also reared its head, we still said that these businesses should have this forbearance. At this time, we believe that the global economy has opened up. The lockdowns have been lifted, and of course, we know the casualties, the economic damages and fatalities that was caused as a result of the lockdown. And I'm so sure that not too many countries, if at all, will, in the midst of this pandemic, want to embark on a wholesome lockdown any longer. Particularly because most countries are all administering vaccinations that they think should assist in reducing the impact of the strain of the virus. So we believe in Nigeria, businesses are back, companies are back to business, revenues have improved, and if revenues have improved, then companies or businesses that took loans, if we say the loans for intervention has moved from 5 to 9, if we say that the moratorium of 2 years expires in March 2022, and of course the restructure that you have graciously benefited remains, then naturally we should expect that companies should be able to pay back their loans. So as a result, we do not see any likelihood of increase in NPLs. Indeed, we have worked so hard to bring the NPL down from as high as almost about 9-10% about 2 years ago to the level that it is today, which is 5.3%. And we are gratified that we are aggressively working NPLs down to the maximum threshold that has been set by the central bank. So I don't think there's any need for anyone to worry at all.
Good afternoon, Governor. My name is Issa Boa from Telegraph Newspapers. The economy is on recovery path. Key indices have shown GDP is rising, the inflation is trending down. How do you think this can be so that Nigerians can enjoy these improvements?
New Telegraph talked about the fact that Nigerian economy has witnessed some improvements. What is CBN doing to ensure that this trend continues so that the economic prosperity of the country, that we can continue to see the prosperity? Well, I think, again, it is important that we continue to commend both the monetary and fiscal authorities for work that has been done for us to exit recession. Again, Nigeria was confronted by a stagflationary situation where inflation was going up and output growth was coming down. If you want to tackle inflation, you have to tighten in order to rein in inflation. And in the process of tightening to rein in inflation, you will take certain decisions that will hurt output growth, it will hurt capacity of financial institutions to grant credit, it will make it difficult for the creation of monies, liquidity will become very tight, and what that would do is that it will constrain manufacturing output and also inferentially also get to hurt output. On the other hand, if for GDP, what you want to do is to see how you can continue to spend money. As you spend because you want to improve output, what will happen is that, yes, you see that growth is improving, but at the same time, that impact of easing, which increased liquidity in the system, will create inflationary pressures on the economy, increase prices, and create problem again for the economy. So you see, the basic issue is the dilemma of monetary policy. And that is why we say that, notwithstanding the peculiar situation that Nigeria finds itself, we are in a position where we're able to manage the balance, and monetary policy committee needed to be appreciated for the fact that rather than take on their own stance, which is price and monetary stability, they have said that they are going to adopt a stance of price and monetary stability that is conducive to growth. And that is why we're seeing what we're seeing indeed. And that is why Monetary Policy Committee prides itself that it has played a significant role in moderation of inflation, in the improved output growth that we're seeing, and overall improvement in recovery of the economy. And of course, all we would expect is that they have said we must continue to still pursue price stability that is conducive to growth. What does that mean? We will do everything possible to continue to support households, everything possible to support small and medium enterprises, so that can catalyze consumption and investment expenditure, help to improve gross domestic product. While on another hand, they have also said, the management should try and continue to use administrative measures to see what can be done to rein in inflation from that side, and at the same time, with its intervention in the other sectors, like maybe agriculture in this case, you would see that agri prices eventually, luckily we've been lucky. In fact, in 2021, we did not hear of any case of flooding at all. And that, for us, I think we must be very thankful to God. As a result of that, we're expecting a very bumper harvest in all our agricultural products. And if this happens, what that will do is that it will considerably dampen inflation and prices, which will continue to help our attempt to continue to rein in inflation and moderate prices in the economy. So we will continue to do these things.
Good afternoon, MPC and Governor. I am Nancy Najik, the anchor of Money Finance on here. I have three questions. The first one is a global component of it. Do you and the MPC have concerns about the impact of the U.S. Fed tapering, as well as the normalization decision on the FX reserves? I checked our FX reserves yesterday, I think about $41 billion. Also that decision on the dollar rates and FX rates in general. Yesterday we saw Jerome Powell being announced again as Fed chair by President Biden.
On the third question, I talked about the concern on tapering, how will that impact and all that. What we saw in the last, I would say, 2-3 years, of course, particularly during the period of COVID, is that we saw a lot of easing, a lot of spending in order to boost economies. And what we have also seen, that it has resulted in the inflationary pressures that are persisting right now, even in the advanced economies, and that is why countries like the United States are concerned and are beginning to think about they need to embark on a bond buying program so as to bond selling program so as to reduce the liquidity in the system and the rest of them. So what does that mean? As they sell the bonds and they withdraw liquidity, yields in those environments increase. As yields in those environments increases, then we will see inferentially a flow of capital from emerging or developing economies back to advanced economies, because those areas are normally their safe havens. So what would that mean? You will see a flow of capital. It will move from the member. But for us, I must say in the last 2 years, we have not quite benefited from it, from those flows as such. Indeed, what we've been saying, that we've been seeing gradual movement out, and the central bank has done everything possible to make sure that as those that we are dealing with the issues of foreign investors taking their monies out in a very orderly manner that does not hurt our system. We will continue to do that. So we don't see how that will hurt our system worse than the situation that we are today. So we'll just continue to do our work, because we did not, those that should border will be countries in the last 2 years that have substantial inflow of forex into their economies. Of course, naturally, they will lose. So there's nothing for us to worry here in Nigeria.
The second one is, in the week of Mr. President's launch of the e-Naira on October 25, the e-Naira is the first African digital currency. I want to know, how is the e-Naira's performance and adoption rate among Nigerians?
The fourth question is asking, what is our assessment of the performance of the adoption of the e-Naira and the rest? I think the only thing I can say here is that it's still too early for us to begin to carry out an assessment, because it's just, I think this is the 4th week now. But I think it is gratifying to see that so far, I think we've seen almost about 560,000 downloads on the website, on the e-Naira platform, out of which 490,000 are consumers and 83,000 are merchants. So we're optimistic that things are going. But let's not forget, like we said, the e-Naira or digital currency product has extremely wide possibilities. There's so many things that can be done. But what we've done initially is to constrain it, begin the journey gradually. We are taking baby steps. So even in the midst of we taking baby steps to see how actors within that globe are behaving to ensure that we're able to control some of the risks that we see, I think that it is a good result so far. As we see the performance of players and stakeholders within that e-Naira market, what we do, we open it up more and more, and we think that it is a game changer for the world and also for Nigeria. So too early to begin to talk about it, but at least by way of update, we are moving closer to about 1 million downloads on that platform.
Then finally, what are the chances of seeing the takeoff of the infrastructure company, as well as the NIFC? I'd like to know where that will be located, and the reorganized Nigeria Commodity Exchange by the year end. Thank you.
By way of update, we are moving closer to about 1 million downloads on that platform. And you're asking for some, are we likely to see some takeoff of Infraco? But on Infraco, let me say that basically, practically all the infrastructure that we need to put in place for the takeoff of Infrastructure Corporation has been achieved. And we thank the President for giving all approvals that are needed. We thank the Vice President, being the chairman of the steering committee, for also giving all the approvals that are needed for us to proceed. Transaction advisors have been appointed. Asset managers are eager. 4 of them have been appointed. The management of Infraco, with just a few number of people, we are currently concluding the appointment of the CEO of the Infrastructure Corporation, who is an expert and first-class person who understands infrastructure business globally, and the rest of them. But we even while we are waiting for the management to get on board,
The shareholders are holding very aggressive meetings, and they are currently reviewing about 3 major projects which eventually will be handed over to the asset managers, and I'm sure that asset managers themselves are salivating and waiting to see those assets come onto their hands so they can begin to fund the infrastructure development of Nigeria. So we are very hopeful that is going on very well. The NIFC, Nigeria International Financial Center, we just feel that Nigeria, being the biggest economy in Africa, should be able to establish a financial center. That is also going on well. We just have about 4 weeks to the end of the year, so I'm not that optimistic that we will. Don't forget, I have said within 12 months we would. But I believe that before the middle of next year, the NIFC should actually begin operation. And we also have received several inquiries from foreign investors and actors in financial centers that are willing to come on board and work with us here. On the commodity exchange, work is also advanced. The team working on that, I think we'll have a couple of meetings to hold. We have to talk about how do we deal with the existing board, how do we deal with the existing management, how do we deal with several other issues and the rest of them. And as soon as we're able to deal with this, I believe we should be ready to take off. Funding should not be a problem.
Good afternoon. My name is Leah Katumbabatunde, and I report for the Nigerian Television Authority. Barely 4 weeks ago, Mr. Governor, you announced the 100 for 100 policy on production and productivity, and following that, we also got some guidelines. Could you speak further to that, though you made mention of it earlier, the changes we're going to see, how you feel is going to impact on the economy? Thank you.
Now, on the 100 for 100 policy on production and productivity, this is basically one of those interventions we felt we should put in place to really help to grow the Nigerian economy, create employment in support of the president's vision that we should create 100 million jobs in 10 years, which is like 10 million jobs in 1 year. That, I must say, is daunting assignment, but I think we all should play our roles from different sectors of the economy, whether from the monetary or fiscal, to see what can be done to help achieve this objective. So here we're looking at how do we begin to really support and catalyze productivity that will help achieve our own policy of import substitution, that we have raw materials in Nigeria such that if the plants and equipment are funded, right, the raw materials that you need to operate those factories are almost entirely available in Nigeria. That is our objective, because we believe that if we do so, we will begin to see that we are truly diversifying the base of our economy. We'll begin to say that what we can produce in Nigeria, we are producing them, and not that we're importing them and exporting jobs to other countries. That we're able to create jobs for our people and not export jobs to other countries. That is what we seek to achieve. And we have said it very clearly, that we will advertise it, we will scrutinize it, we will ensure that all the indices necessary in terms of employment, raw material content are all measurable. We can see it before we embark on that project. And if anybody is doing anything that is wrong, Nigerians will be there to say it. So I believe that is something that is also revolutionary, and I think will also help to ensure that, I keep saying, our own, what is our selfish interest? If we fund industries that will produce what ordinarily we import, produce it locally, create jobs, right? It also saves the dollar that would have spent importing those goods. And that is where our own selfish interest is. And that's why we continue to talk about what is our own really selfish interest in this. Our selfish interest is that we want to work hard to reduce the size of foreign exchange that people come to ask for to import goods that can be produced within Nigeria. And we are really very determined to achieve this, and we are calling on the support of everybody to achieve this objective.
Good afternoon, Mr. Governor.
his team. My name is Chinemere Joseph, the anchor of You and the Economy. My question is, latest figures from the National Bureau of Statistics indicate that Nigeria's GDP grew by 4.03% year on year in real terms in the third quarter of this year, which you highlighted. Now, showing a sustained positive growth over the last 4 quarters since the recession we witnessed in 2020. Without preempting your outlook for the next year, which we expect later this week, when you attend the annual dinner of the Chartered Institute of Bankers of Nigeria, are you optimistic that these figures will continue in this positive trajectory? Thank you.
Chinemere talked about the figures, about the growth and all that, and that without preempting my outlook. I think don't preempt my outlook. By Friday, we'll talk more about it. You hear about it. But I think that what is important is that we're very upbeat about the progress that we've achieved so far in the economy, and what we can see if we keep doing the right things, is that yes, we are still far from double-digit growth, but I believe Nigeria will move aggressively, keep doing the right thing, stop doing the wrong things, focus aggressively on them tenaciously. I think the growth levels will move aggressively upwards. We are expecting that growth for 2021 certainly will be above 3. We are so certain to be above 3. So if we take it on from there, of course, 2022, we'll expect that it will move towards 4, if not better, if we keep doing the right things. Because whether we like it or not, as economists, there must be ceteris paribus. All things being equal, because if something happens and that makes it difficult for you, you will tell the whole world, this is where we planned we should be, but ABC happened, and so we couldn't achieve it. Unfortunately, this is what we achieved. But we don't pray that those negative ceteris paribus happen, so that we can continue on the right course and the rest of them.
The next question is also from Collins Wednesday of the National Newspaper. He said, recently, there have been cases of deductions of money from the accounts of customers by some deposit money banks without specifying what those deductions or charges are meant for. What is the CBN doing to restrain the banks from such actions?
Yes. Well, I think talking about bank charges. The Central Bank of Nigeria insists that consumers of bank services, in these customers, must seek, and indeed, if it is not on CBN website, I'm going to ask that we place it on our website, the guide to bank charges. Go and read your guide to bank charges. You should not allow any bank to just pass on any discretionary charges on your account that is not contained in the guide to bank charges. Hold it as your Bible as you deal with the bank. If you find any that is not, raise an alarm. We have our Consumer Protection Department. We have always advertised our own hotlines and emails where you can always reach us. And indeed, we have seen cases in the past where people have raised an alarm, and it has resulted in hundreds, if not even billions of naira reversal back to customers' account. So I can only say, if you are being charged by any bank for transactions that did not happen, or charges that are not inside or stated in the guide to bank charges, you have to ask the bank to reverse it, because it is not meant to be there.
And then finally, from Babajide Komolafe of Vanguard newspaper, there has been a raging controversy about who is the highest individual shareholder in First Bank PLC. As the apex bank regulator, what is the position of the CBN on this? Thank you, Governor.
Now on First Bank, yes, you are right. We've been reading about some newspaper talks about that. You know, for us, yes, newspaper talks. With due apologies to the press, we will continue to read these stories. But the point is this: I think it's good for us to cast our mind back to the position of First Bank 6 years ago. 6 years ago, when CBN started its program of looking at the bank to reposition, let's not forget, First Bank remains the oldest bank in Nigeria, 1894. It is I use the word, strong, aggressively, domestically important bank in Nigeria. If anything happens to First Bank, it means something has happened to the Nigerian banking system. And that is why we're taking our guidance about how to get the bank back afoot very seriously. 6 years ago, like I said, because of the build-up, an aggressive build-up of non-performing loans on the books of First Bank, the share price of First Bank was about 2 naira per share. We took it on, right? Everybody was running away from the shares of First Bank. Because we have cleaned the balance sheet now, the NPLs have dropped aggressively. People are seeing that this money-making machine, First Bank, is back again on the race for profitability. They are now competing for the shares of First Bank. Why should I quarrel that people are competing for the shares of First Bank, which 6 years ago was 2 naira, and they were running away from it? And today the shares of First Bank, and the last time I looked at it, was 11 naira 55 kobo during the weekend. I'm happy to see that they are competing for the shares. But of course, they should all know First Bank is so big that not one person can say he owns First Bank. They are just one, and they should see themselves as representing others in running the bank. Okay? I have read Securities and Exchange Commission clarify the issue of shareholding percentages of different, and indeed they are the people that are supposed to do so. Our examiners themselves are also continuing to look at it, and we will, I think we should take SEC's position, because SEC is a regulator of the capital market. We will take their position and they will give guidance on this subject. But of course, as it affects the running and operation of the bank, we will take preeminence in ensuring that the right things are done. But of course, our examiners are looking, of course, naturally, returns are sent to Central Bank of Nigeria about people, individual shareholders. And of course, if our position is not in tandem with the position of SEC, we'll talk to SEC about it and we'll also advise the public. But so far, I would say that we should take the position of SEC as a regulator of the capital market, because regulating share price ownership is the sole responsibility of SEC, and we would not want to override SEC, the regulator, on these issues. But we'll continue to work with them, and we'll have very, very good relationship with them. But I would just say, I am very happy that people are scrambling today for the shares of First Bank.
This is the last Monetary Policy Committee. I wish you all a very Merry Christmas, Happy New Year, and I think enjoy 2021, and let's meet in 2022 again. Good afternoon.
Yeah, thank you, Governor. And with that, we'll come to the end of this press briefing. Of course, this is the last of the Monetary Policy Committee meeting for the year 2020. And God willing, we shall see you in January 2022. Thank you, and God bless.
All right, see you guys.